Welcome back, my friends. Well, the news today is that none other than Warren Buffett's Berkshire Hathaway has made some big bets on the US housing market, buying some big names in the industry. Homebuilders D.R. Horton, Lennar, and NVR Corporation, and lumber materials company Louisiana Pacific. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. And, before we continue, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty. Nurses, and that includes all grades of nurses. Lawyers, regardless of area of legal focus. Teachers and professors, from kindergarten through graduate school. As well as any kind of job that requires a government license or certification. And ProWorld.net also includes short-term gig-type jobs as well. So, be sure to check out ProWorldNet.com if you are looking for a job or an employee. Warren Buffett's company appears to be betting on the housing market picking up because Berkshire Hathaway bought more than $700 million worth of homebuilder D.R. Horton stock this spring, along with smaller stakes in fellow builders Lennar Corporation and NVR Corporation. According to the firm's 13F fund manager, filing with the U.S. Securities and Exchange Commission after trading ended on Monday, Buffett bought around $4.6 billion worth of shares in the quarter, led by the homebuilders, which some analysts said was somewhat surprising. Berkshire displayed new stakes in homebuilders D.R. Horton, Lennar Corp., and NVR Incorporated. The position in D.R. Horton was by far the largest at 5,969,714 shares. The firm also owns 152,572 shares of Lennar and 11,112 shares of NVR. Analysts noted the surprising positions considering the challenges U.S. homebuilders have faced due to higher interest rates, which have slowed homebuilding activity. Some analysts suggested these stakes could be a bet that interest rates will fall and that home buying and building will surge again. In addition to the home building trio, Berkshire increased its holdings in Capital One Financial and Occidental Petroleum. The stake in Capital One, which was put on credit watch by Moody's last week for a possible downgrade, grew from 9,922,000 shares to 12,471,030 shares. The stake in Occidental rose from 211,707,119 shares to 224,129,192 shares. There were also sales in the quarter. Berkshire reduced its holdings in game maker Activision Blizzard, specialty products group Celanese, oil major Chevron, General Motors, and insurer Globe Life. Buffett's managers closed out the company's stakes in insurance brokers Marsh & McLennan Companies, drugstore chain McKesson Corp., and Vitesse Energy Incorporated. Berkshire maintained its 915,560,382 share stake in Apple, by far its most valuable position and worth more than $170 billion at the end of June. Berkshire shares closed slightly higher on Monday, before the 13F filing details were made public, at $543,150 each, up $250 on the day and well under the record high of $555,800 hit last week. Analysts predict that shares in the three homebuilders will rise when trading resumes for the Tuesday session due to Berkshire's appearance as a shareholder. Lennar shares closed at $123.87 on Monday, D.R. Horton shares at $123.28, and NVR shares ended at $6,158.70. The housing market is grinding to a halt. Rising mortgage rates and still elevated commodity prices caused new single-family housing starts to decline 4% in November, the latest period, while residential permits tumbled 11% for the period. The National Association of Home Builders Housing Market Index sits just above the lowest point hit during the onset of the pandemic. So why did Warren Buffett's Berkshire Hathaway buy Louisiana Pacific NYSE, LPX, a leading manufacturer of building products, including engineered wood products, siding, and other products used in residential and commercial construction? Although existing home sales fell 7.7% in November, the 10th consecutive month they've been down, there is actually a housing shortage in the U.S. It's considered a shortage when there is less than a 6-month supply of existing homes for sale. The National Association of Realtors said in their most recent update that there are just 1.14 million unsold existing homes, or just 3.3 months worth of inventory. For that reason alone, the housing industry isn't expecting the same sort of wholesale plunge in pricing that marked the collapse of the housing market 15 years ago. Today, the median existing home sale price is $370,700, an increase of 3.5% from last year. It may be more of a buyer's market now, but it's not the route many have been expecting. There may be some pessimism among homebuilders, but there are several reasons why Louisiana Pacific could still be a good investment opportunity. Of primary interest is valuation. Even after news of Buffett's purchase sent LP's stock soaring in November, the stock remains 16% lower over the past year, and is 22% below the highs it hit in 2022. Shares trade at an enviable 4 times trailing earnings and just 16 times next year's estimates, while also going for a fraction of the company's estimated earnings growth rate. Of course, at a compounded rate of 5% annually for the next 5 years, Wall Street isn't expecting a massive growth spurt, but trading at just 5 times the free cash flow Louisiana Pacific produces, shares certainly give the appearance of offering a bargain basement discount. The wood products company itself doesn't often trade at sky-high premiums, and sometimes a stock is cheap for a reason. Analysts are expecting the housing downturn could impair LP's future prospects. Fortunately, the company has been transitioning to a more holistic approach to the industry, and is building up a greater presence in the repair and remodel market, as well as developing value-added products. LP's focus on innovation has been a key driver of growth, as it's invested in research and development to develop new products and technologies. This, in turn, has helped the company to improve efficiency and lower costs, which has improved margins. Its siding business saw a 27% increase in third-quarter sales, which it says helped set new records for pricing and volume, while its structural solutions unit saw sales volumes increase 10% year-over-year. Oriented strand board, or OSB, still comprises the largest component of Louisiana Pacific's business, but it's trying to take that in new and innovative directions. For example, in the Structural Solutions division, it created a radiant barrier product for OSB, which is an aluminum panel affixed to the plywood that helps block heat from emitting into an attic space. Its air and water barrier panel protects against the elements, while also increasing the structural integrity of the house. During the quarter, the majority of the revenue for LP's OSB segment came from its specialized Structural Solutions portfolio. Louisiana Pacific has a solid balance sheet, with low debt levels and a strong cash position. This gives the company the financial flexibility to make additional investments in growth opportunities while weathering any short-term challenges. But as a lumber stock, it's cyclical, and buying now means having the patience to let the sector rotation continue until the housing market is back in favor. It might not decline as sharply as it did a decade ago, but these depressed valuations may be with LP for a while. In the meantime, the wood products company should continue to return value to shareholders through a nominal dividend payment that currently yields 1.4% annually, while buying back large tranches of stock. It has cut its outstanding share count in half over the last 5 years. But, as you probably know, not everyone is so bullish on the U.S. housing market. Last month, Bloomberg reported that Starwood Real Estate Income Trust plans to shop more than 2,000 single-family rentals. Starwood hasn't publicly explained its motive for pulling back from the residential housing market, where its right owns over 3,200 single-family homes. That said, it's clear that the decision to shop these 2,000 homes comes as Starwood faces an uptick in redemption requests and endures pain in the commercial real estate sector. At first glance, one might assume Wall Street types would pull back from the commercial real estate space, where office values are sinking fast, and instead pile into the residential housing market, where national home values are rising again after passing through a mild home price correction last fall. However, institutional firms are also timid on the residential front. According to an analysis conducted by John Burns Research and Consulting, institutional investors, those owning over 1,000 homes, bought 90% fewer homes in January and February than they did in the first 2 months of 2022. Why are institutional investors pulling back so fast from the U.S. housing market? It boils down to the fact that the financial return on each additional home added just isn't that great right now after factoring in interest rates, house prices, and rents. Look no further than Invitation Homes, the largest owner of U.S. single-family rental homes, which recently became a net seller. In the first quarter of 2023, Invitation Homes bought 194 homes while it sold off 297. A year earlier, in the first quarter of 2022, Invitation Homes, which Blackstone helped to grow before divesting in 2019, bought 822 single-family homes and sold off only 147. Invitation Homes isn't alone. American Homes 4 Rent was also a net seller in the first quarter. In the first quarter of 2023, American Homes 4 Rent sold off more single-family homes, 666, than it bought, 312. That net decline saw the Las Vegas-based company's portfolio shrink from 58,993 rental homes across the country to 58,639 homes. A year earlier, in the first quarter of 2022, American Homes 4 Rent bought 1,131 homes and only sold off 171 homes. If you follow this channel, you already know that the Federal Reserve is aggressively raising interest rates. And the rising interest rate environment is sending real estate values into decline. The real estate market has been hit hard, especially commercial real estate. Practically everyone is raising questions about the actual values of real estate. If you follow this channel, you already know that real estate prices are falling across the United States. Institutional investors snapped up properties during a stimulus-fueled frenzy. But now, rising interest rates have shifted the sands. And they are now unloading their properties in a hurry. For these investors, profit margins have crashed. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.